Imagine you run a neighborhood piggy bank. Every day, people hand you money because they trust you to keep it safe. You do not just leave that money sitting in a drawer. You try to earn a little extra by locking some of it into long-term investments. That works fine until one day, everyone shows up at your door at the same time asking for their money back. That, in simple terms, is what happened to Silicon Valley Bank. And the crazy part is, this was not some tiny, shady bank on a street corner. This was the bank for startups, the place where thousands of tech companies parked their money, the bank that looked smart, modern, and deeply connected to the future. So how did a bank trusted by the innovation economy collapse in just days? To understand that, we need to start with a time when money was everywhere. For years, especially after the world was hit by the pandemic, interest rates were extremely low. That meant borrowing money was cheap. Investors were desperate to find places where they could get better returns, so they poured mountains of cash into startups, new apps, new software companies, new delivery businesses, new AI tools. If it sounded futuristic, it got funded. And when investors gave startups that money, the startups needed somewhere to keep it. A huge number of them chose Silicon Valley Bank. This gave the bank a very unusual customer base. Most banks have all kinds of customers: teachers, restaurants, families, retirees, small stores, big companies. But Silicon Valley Bank was different. Its customers were heavily concentrated in one world: tech startups and the investors behind them. That was the first hidden weakness. On the surface, it looked like strength. If you were the favorite bank of Silicon Valley, that sounds prestigious. But in reality, it meant the bank had put a lot of eggs into one basket. And then came the second problem. The bank suddenly had tons and tons of deposits. Startups raised cash, venture capital firms raised cash, everyone parked money there. The bank needed to do something with all that money. Banks usually lend a lot of it out, but there was so much cash coming in so fast that Silicon Valley Bank bought a huge pile of bonds instead. That sounds boring, safe even. And normally, bonds are considered much safer than wild startup bets. But here's the twist: safe things can become dangerous if you buy them at the wrong time. Silicon Valley Bank bought lots of long-term bonds when interest rates were very low. That choice would come back like a boomerang. Here's the easiest way to think about a bond. Imagine you buy a coupon that pays you a fixed reward every year. If new coupons later come out with much better rewards, your old coupon suddenly looks less attractive. If you want to sell it, nobody wants to pay full price for it anymore. That's basically what happens to older bonds when interest rates rise. And interest rates did rise fast. The Federal Reserve started hiking rates aggressively to fight inflation. Money was no longer cheap. Borrowing got harder. Startups could no longer raise easy cash the way they used to. Investors became stingier. The startup party started to slow down. That created a double squeeze on Silicon Valley Bank. First, the bonds it had bought while rates were low started falling in value. Second, its customers, the startups, began burning through their cash. Remember, many startups do not make steady profits. They live on investor money while they try to grow. When funding becomes harder to get, they start using the money already sitting in the bank. They pay salaries, rent, cloud bills, lawyers, recruiters, ads, everything. So instead of deposits flooding in, deposits started flowing out. That's a dangerous moment for any bank, because if customers want their money back, the bank needs cash. And if too much of its money is tied up in long-term investments that have dropped in value, the bank has a problem. At first, this problem was mostly hidden. On paper, the bank still had assets. It still owned those bonds. If it could hold them long enough, many would eventually pay back as expected. But banks don't live in a perfect world where they can always wait patiently. They need liquidity. They need money available now. Silicon Valley Bank was slowly getting cornered. It had a customer base under pressure, it had investments losing market value, and it had a business model built for an era of easy money just as easy money was disappearing. Then came the moment that turned a bad situation into a panic. The bank announced that it had sold a chunk of its assets at a loss and needed to raise new capital. That may sound like a routine corporate move, but in banking, messages like that can be explosive, because what people hear isn't "we're making adjustments." What they hear is, "Wait, do you need cash badly?" And if depositors start asking that question, things can spiral very quickly. This is where banking becomes almost psychological. A bank can survive many things, but it cannot survive a loss of trust. Banking is built on confidence. People leave money in the bank because they believe they can get it back whenever they want. If that belief cracks, everyone rushes at the exit at once, and no bank is designed to handle all depositors demanding all their money at the same time. That's a bank run. And in the old days, a bank run looked like people lining up outside branches. But this was Silicon Valley. This was startup land. This was group chats, private investor networks, and phones moving millions of dollars with a few taps. collapse. So when fear spread, it spread at internet speed. That's the third big twist. This was not just a normal bank run, it was digitally accelerated bank run among some of the most networked people in business. Venture capital firms began telling portfolio companies to move their money. Founders texted founders, investors warned CEOs, Slack messages flew, group chats lit up. What might have once taken days now took hours. And once that kind of panic starts, each person feels forced to act. Even if you're calm, you still think, if everyone else pulls their money and I do nothing, I could be the last one stuck. That logic becomes self-fulfilling. The run gets bigger because everyone expects the run to get bigger. Suddenly, customers tried to withdraw astonishing amounts of money, billions upon billions, far too much, far too quickly. The bank couldn't keep up. At this point, the story was no longer just about one bank. It was about contagion. If one bank serving the startup world could collapse, people began wondering which bank is next. That's how financial fear spreads. It rarely stays neatly inside one box. It jumps. It infects confidence elsewhere. Investors, founders, depositors, and regulators all start scanning for similar weaknesses. Regulators stepped in and shut the bank down. For many people, especially startup founders, this was a nightmare. Companies suddenly feared they might not be able to pay payroll. Imagine running a business with employees expecting paychecks in a few days while your money is trapped inside a failed bank. Even healthy companies can start panicking in that situation. The question became urgent. Would depositors get all their money back? Normally, bank deposits are insured only to a certain limit, but many startups had far more than that parked at Silicon Valley Bank. Not thousands, not even just hundreds of thousands, sometimes millions. So the fear wasn't simply, my bank failed. It was, my company's lifeblood may be gone. That's when the government took extraordinary steps. Regulators announced that depositors would be protected even beyond the usual insured limit. The goal was simple: stop panic from spreading further. Because if businesses across the country started doubting whether their money was safe in regional banks, the problem could snowball into something much bigger. This decision helped calm things down, but it also sparked debate. Some people argued it was necessary. Others said it looked like rescuing wealthy startups and investors from a mess that should have taught them a harsher lesson. And that brings us to the deeper question: was Silicon Valley Bank just unlucky? Not really. Yes, rising interest rates were a major trigger. Yes, the startup slowdown hurt badly. Yes, social media and digital banking made the run terrifyingly fast. But underneath all of that were basic mistakes. The bank had concentrated too much on one type of customer. It had become deeply exposed to the fortunes of the tech and venture capital world. When that world was booming, the strategy looked brilliant. When that world slowed, the weakness became obvious. It had also taken interest rate risk too lightly. That sounds technical, but the idea is simple. It bet too heavily that rates would stay low, or that it would have time to wait things out. It locked up too much money in long-term assets without preparing well enough for what would happen if customers suddenly needed cash. And this is the third twist. The bank did not implode because its customers were poor. Many were well-funded startups with serious backers. It imploded because timing, concentration, and confidence all snapped at once. That is what makes bank failures so dangerous. They often look calm until the final moment. Then everything happens at high speed. One day, the bank is a respected pillar of an industry. A few days later, it is gone. There is also a broader lesson here about money during boom times. When cash is pouring in, people often mistake favorable conditions for permanent genius. A business can look incredibly smart simply because the environment is easy. But when the weather changes, you find out whether the house was built on rock or sand. Silicon Valley Bank had ridden a historic wave of startup money. It looked perfectly positioned for the future, but it was also quietly built around assumptions that depended on low rates, abundant venture funding, and stable depositor behavior. Once those assumptions broke, the machine broke with them. And there is one more reason this story matters. It showed that modern financial crises can move faster than old ones. In the past, fear traveled by newspaper, television, and physical lines outside branches. Now it travels by tweet, screenshot, podcast clip, investor email, and encrypted message thread. Confidence can evaporate before lunch. That means regulators, banks, and businesses are all living in a new reality. A rumor can become a run. A concern can become a collapse. A mismatch on a balance sheet can become a national emergency in a weekend. So what killed Silicon Valley Bank? Not one bad loan, not one evil mastermind, not one giant fraud. It was a chain reaction. Too much money came in from one overheated industry. too much of that money was parked in long-term assets at the wrong time. Interest rates rose and crushed the value of those assets. Startups began pulling cash as funding dried up. The bank revealed losses and tried to raise money. Trust cracked. The internet amplified fear. Depositors ran, and the bank fell. In the end, Silicon Valley Bank failed for the oldest banking reason of all. It ran out of time before it ran out of assets. And that is the strange heart of banking. A bank can look rich and still die if it cannot turn its wealth into cash fast enough. Like a person owning a mansion, a yacht, and a rare painting, but having no money in their wallet when the bills come due. Silicon Valley Bank was not just a story about one bank. It was a warning about concentration, complacency, and how brutally fast trust can disappear in a digital world. Because in finance, once people start asking whether